Welcome back to the Personal Finance Project. I am Scott Bartosh, coming to you today alone because Greg looked at the topic and knew that this was a terrible idea. So today we thought we would change it up a little bit and dive into an area of personal interest for me. And that is not necessarily this particular forum, but this website. I will admit to everyone that I am a Redditor. I really enjoy it. It's a website where you can have an extremely niche interest and find other people who share that exact same really niche interest. And so for things like Astros baseball or travel, it's my go-to place because I can find people who are interested in the same places and things and languages and sporting events and all that kind of stuff. So today, I thought what we would do is look at a pretty popular subreddit, which got a lot of attention several years ago in what you would call the meme stock craze. I think that it's okay for me to talk about a specific company in this instance, in that in 2021, as everyone was kind of getting maybe a little bit crazy from the COVID situation, we had GameStop, which rose from the ashes as a company that basically was going out of business to suddenly a media darling. There's a movie called Dumb Money about, the Redditors, basically, that propped up this company. And now, several years later, I'm not really sure if it's something I'd invested my money in, but it's pretty clearly not going bankrupt and it's still around. And Wallstreetbets, which is the subreddit that we're going to look at today, is still around. So today what we thought we'd do is take a look at some relatively recent posts on Wallstreetbets, and I'm going to give you my reaction to the ideas and the concepts that they're talking about. Before we jump into this, I do want to do just a little bit more prefacing and say that Wallstreetbets can get a little bit spicy and risque. So if you do go there and you see something that offends your sensibilities, please be warned. So the first one that we're going to look at, this is a meme that we'll put up in the video version, and it's Mr. Trump looking at his whiteboard of reciprocal tariffs, and the caption reads, your calls are cooked when the board comes out. And so what this meme is getting at is we're going to just do a little bit of things you pretend to know while we're in the middle of Wallstreetbets. So in this instance, what's happening is the market, or the subreddit, is reacting to Trump's announcements of reciprocal tariffs in April. And on the board, you can see these extremely high tariff numbers, some of them up 60, 70, 80%. If you guys recall, Liberation Day, when Mr. Trump came out with all of the tariffs that were going to be employed, the market in about 2 weeks was down about 20%. So we had a really, really swift correction. And so what the meme here is doing is it's calling out that if you own call options, if you were a bull, especially on the short part of the time horizon, you were probably going to have a really bad time with the announcement of tariffs. And I think that's another thing that's, as we kind of look at some of these Wallstreetbets articles and commentary as we go forward, is understand that the name Wallstreetbets is a huge part of what's happening there. This is not investing in the way that Scott and Greg talk about it. This is speculation at a minimum, gambling at a more aggressive description. So this is people who are really, really aggressive, probably investing in companies that you're not familiar with, and very likely short duration call options. And if we think about what happens when you're buying a call option, is you are making a prediction about where a stock is going to go at some point in the future. If you buy a call option that is 6 months out, it means that you're saying, all right, within the next 6 months, I'm hoping that the stock that I've chosen goes up in price enough to where I can either exercise the option and get shares at a lower price, or I can sell the option to somebody else and make a profit on it. What happens a lot on Wallstreetbets is people will talk about 0 days till expiry, which basically means you're buying an option that is out of the money, and your hope is that in 1 day or maybe 2 days maximum, that stock is going to move dramatically enough to take you from out of the money to in the money. A call option has 100 shares associated with it. So you can imagine if you buy many options of 100 shares each for, 2 or 3 cents per contract, if everything worked out perfectly, you could make a ton of money this way. So what this meme is really kind of just saying is that if you're making bets that are super short run, you're going to really run into trouble when something like tariffs is announced. So the second one that I thought we would take a look at, and this is just funny for me as somebody who has 2 monitors, as I look at the stock quotes and look at how things are going in the market. It's the typical Wallstreetbets trader versus an index investor. And I would say that, Greg and I have done a little bit of poking holes in index strategy and talking about how, just because something is a huge company doesn't necessarily mean that you want to own tons of it. And that's a reason why, we tend to not be huge indexers in our practice. But what I think they're going to get into here is just the difference between some of this really aggressive speculation that happens on Wallstreetbets and the longer term buy and hold dollar cost averaging investor that we tend to work with. So the description here, and this is a picture from the Olympics, a gentleman with a very aggressive style of shooting a rifle in his stance for the Olympic shooting competition. 4 monitors, 6 brokerage accounts, 15 stock forums, 40 to 50 trades a day, down 60% today. And then there's a gentleman who doesn't have any additional gear on, just looking straightly at the target with his handgun. And this is the index investor. Been dollar cost averaging into SPY for the past 12 years, has no idea what's happening in the markets because he hasn't checked his portfolio in a decade. And I think that's a great way to sum up the clients that, frankly, we get the best results with. And this is not to say don't look at your account or don't think about your investments or don't do due diligence. But, going back to an expression that our senior partner, Richard, has used before, a portfolio can be like a bar of soap. The more you touch it, the smaller it gets. And so what we're seeing here is constant intervention, constant trading, having money in multiple different accounts so that you can see how things are going. I don't even know what the point of having 6 different brokerage accounts would be. The 4 monitors, it at least looks cool. So what we're looking at here, we're seeing the Wallstreetbets investor who's made his 0 days to expiry call option choices for the day. He's lost, half of his portfolio, while our gentleman who every single month puts a few $100s in the S&P 500, doing quite well. And, as we look at our portfolios, that is one of the things that we try to recreate even once you've retired. And that's one of the things that I think people stop thinking about as they get towards retirement. When you're working, everybody likes to talk about dollar cost averaging and how the effect of putting a little bit of money into the market every single month, you'll get better results over time. The idea is when the market is up, you're buying a little bit less. When the market is down, you're buying a little bit more. In retirement, people think, well, I have this kind of omnibus portfolio that's never going to change. And so therefore, I'm going to lose the impact of dollar cost averaging. And what I would tell you is that the way that we manage our accounts with things that are going to be paying dividends in aggressive style accounts, our goal is to recreate that dollar cost averaging stream with your organic investments. And so if you think about it, say you have $100,000 in the S&P 500, that is going to pay out 1.5% as a dividend. But that's $1,500 a year, which doesn't sound like a lot. But if on a quarterly basis, you're basically putting $400 a quarter into the market when the market is low, you're going to get a little impact from dollar cost averaging. And the longer you leave that investment alone, the more that impact will increase over time with compounding. So this is all really just to say that the more creative way of investing, the more aggressive way of investing, you can get a flash in the pan. You could double your money very, very quickly. But I can also tell you from looking at this subreddit and talking to people who've made really, really aggressive choices with their investments, it can unravel very quickly. 2008-9 was the most recent time that happened. I feel like to some degree it gets talked about a little bit less because if you didn't panic sell in 2009, most people clawed their way back to even by maybe 2013 or 14. More recently, I think or a little bit further back in time, the one that I think really stuck with people was the dot-com bubble. Because 2008-9, the market went down a ton, but most of the companies with, setting aside some banks and some car companies that had to get bailed out, most of those companies eventually recovered. In the dot-com bubble in 2000, you had many, many companies that did not have earnings that within a few years ceased to exist. So if you had any significant amount of money invested in those stocks, you may have lost everything and it never came back. So that is another one of the reasons why for the people that we work with, we're not making these choices. We're not investing in these companies that don't have earnings and that are basically, they need everything to go perfectly for the market to reward them for what they're doing. So the last one that I picked out today, and this one, I think this one to me, it does a decent job of encapsulating how, one, helpless it can feel to be an investor in a really challenging world, but two, I think in a way, it really kind of is a mirror to look at yourself and say, all right, if I am making these really aggressive stock choices, or if I'm making the call of now is the time to sell, or now is the relative time to buy, and I'm going to pick one direction that the market is going to go, think about that a little bit closer, because listen to this scenario and let me know how you would feel about your personal opinion that the market is going to do one thing or the other. So this is from about a month ago, and the title is Iran launches missiles. It's already priced in. Don't even ask the question. The answer is yes, it's priced in. Think the U.S. will retaliate against Iran? That's already been priced in. You live in New York City and see missiles flying overhead. The news hasn't reported on yet. Priced in. You think insiders don't already know that? The market is an all-powerful, all-encompassing being that knows the very inner workings of your subconscious before you were ever born. Your very existence was priced in decades ago when the market was valuing Standard Oil's expected future earnings based on population growth that would lead to your birth. What age you would get a car, how many times you would drive your car every week, how many times you take the bus, train, etc. Anything you can think of has already been priced in. Even the things you aren't thinking of. You have no original thoughts. Your consciousness is just an illusion, a product of the omniscient market. Free will is a myth. The market sees all, knows all, and will be there from the beginning of time until the end of the universe. The market is already priced in the heat death of the universe. So please, before you make a post on Wallstreetbets asking whether Bitcoin has priced in a nuclear war or whatever, know that it has already been priced in, and don't ask such dumb questions. So this is obviously satire, even for Wallstreetbets, but I actually think it's pretty funny, and I think there's a lot of things that they touch on that are really a part of the market that we work on, because this happens so frequently, I feel like, especially in the last few years, where we would get something like that Saturday. It was Saturday. I remember I was at a baseball game in California with a friend of mine, and we saw the news that the U.S. was striking Iran. And my thought was, wow, the market is going to be down a lot on Monday. And that was kind of the hubbub over the weekend. And then we got to that Monday after the US bombed Iran and the market was up. And we get to this point where, now we're within a couple of weeks of the tariffs being re-implemented, and we're having Mr. Trump come out and announce tariffs on South Korea and Japan and Cambodia and some of these other countries. And my thought tends to be, well, shoot, the market's not going to like that. It wants free trade. It doesn't want any tariffs. And today, the day that the Japan deal was announced, the Dow is up 400 to 450 points as of doing this podcast. So I think it's interesting to think about the fact that the market it really is a behemoth. And what you are doing individually, what even every single person on these subreddits, these investing clubs is doing, it is such a pebble in this gigantic pool that is the market. And so as a final thought on this, I think it's interesting to turn it back to look, as I mentioned before, as a mirror to look at yourself and say, okay, the market is this behemoth, this monolith. It is valuing these companies. It is looking way out into the future. As he mentioned, it knew when you were going to be born based on Standard Oil's earnings projections. What leads you to think that you can beat it? What leads you to think that you know better than firms that have 100, 200, 500 analysts that are poring over this data in ways that I don't understand? And Greg, despite being a really bright guy, also does not understand. Nobody in this office knows exactly where the market's going. The best we can hope to do is get close and have good allocations, good tax management, and strategies that, going back to the second meme, work if you implement them consistently in a disciplined fashion and do so over a very long period of time. So with that, I think we're gonna call it on the first of our Scott Reacts to Wall Street Bets. Probably our final Scott Reacts to Wall Street Bets, but we'll see how it goes from here. I guess I want to, before I wrap, just reiterate that this is out there. And these are things that people are thinking about the market and investing. And there are people out there that are literally just gambling with money. This is not an endorsement of that. This is a pretty clear-eyed critique, frankly, of that style of investing. But I do hope that it gives you just a little bit of context in what the people that we work with are having to deal with if you're trying to make all these decisions yourself. So, let's just say, you're managing your own portfolio and you suddenly see everybody and their mom and their cat and their sister talking about GameStop in 2021. There's a very reasonable possibility that you bought at the peak of the hysteria, and really, regardless of where we go from here, you're probably never going to be made whole. I mean, if you bought at the peak of that run up, the stock's done okay since then, but there's just not a whole lot of heft to that rally anymore. And so I guess what this is to say is that when you get a hot stock tip from your friend, or you see something on CNBC that sounds too good to be true, it probably is. And talking with somebody like Greg or myself, even if we're not going to give you the stock that's going to make you a millionaire overnight, I think it's a durable strategy that is worth pursuing over time. If this content is something that you would ever consider listening to again, go ahead and hit that like or subscribe button today. We really appreciate all of our listeners. You can catch us on Spotify, Apple Podcasts, or YouTube. Thanks a lot.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.